And I think had Japan not massively ramped up its quantitative easing program on Halloween and frightened the heck out of everybody, I'd have been very convinced in saying that there was going to be more volatility coming. Even now, I think it's going to be impossible to have less. I know that everybody got very upset when the FTSE 100 moved by more than 2% in one day on the 15th of October. But that was the first move like that for nearly 18 months. And there have actually been 383 of those moves since 1994, the equivalent of one every 14 trading days. So I can't see how you can't get more volatility from here, particularly given that central bank policy is starting to diverge. Equally, should people be frightened of that? Not necessarily. It probably means the going is going to get choppier, but as Benjamin Graham or Warren Buffett would say, volatility gives you a chance to buy good stock cheaply and sell overpriced stock expensively. So it could be opportunity. I think the secret now is making sure that clients' portfolios are sufficiently well poised so that they can get through any period of volatility, come out the other side, and then make the most of the opportunities that present themselves. I think there are lots of classic indicators that people can check just to sort of gauge market sentiment. For me, some of the classics are the Dow Jones Transportation Index, Dow theory of Richard Russell. If the companies shipping the goods are doing well, the companies making the goods are clearly doing the right things as well. And at the moment, the transport is making new highs. So that's a tick in the box. Small caps have rallied, but are still nowhere near where they were in March. So that's probably a negative right now. Emerging markets have underperformed since around mid-2011. That's a negative right now. And also look at junk bonds, ultimate appetite for risk indicator in this yield-starved world. You can do that through two US-quoted junk bonds, tickers JNK and HYG. They've bounced a little bit, but again, not got back to where they were. For me, they'd be the four key indicators of risk appetite right now. Transports, junk, small caps and emerging markets, and it's fairly evenly split. Do I think Abenomics will work? I've been treating it whether Mr. Abe himself thinks Abenomics is working, given that he and Kuroda-san at the Bank of Japan have doubled down on their QE program. Japan has slipped back into recession. Abenomics isn't working. Inflation isn't at 2%. Abenomics isn't working. Exports haven't picked up. Abenomics isn't working. Wage inflation hasn't picked up. Abenomics isn't working. But the Nikkei 225 is going through the roof. Bond yields are depressed. And there is an awful lot of corporate governance change in Japan. The more focus on shares, more focus on dividends. So it'd be wrong to say they're achieving nothing, but at the moment it's the capital markets who are getting the benefit, not the Japanese consumer, the Japanese citizen. In the end, the Japanese have got to feel the benefit, or the Nikkei's run will run out of steam. But given the pension fund reform as well, there's a wall of money moving towards Japanese stocks right now. That could continue to keep them to run for a while. You may need to hedge the yen to be on the safe side, because that's probably the sacrificial victim. Is Abenomics working in terms of what it really wants to do? No sign yet. Social reform's a 20-year program, give them a chance. Stock markets don't seem too stressed at the moment. The dollar strength is probably one of the biggest features of the markets in 2014. I mean, there have actually been two structural dollar bull markets and two bear markets since Richard Nixon resigned as US president in 1974. And I think we are probably looking at the third dollar upswing right now. There are two possible explanations. One, the market is simply pricing in tighter monetary policy in the US, or at least tighter relative to the rest of the world, given that Japan is veering off into looser policy, Europe may be following, the UK seems to be in neutral. The second option is perhaps a little bit more worrying. The dollar is the ultimate haven asset. It's where markets go in times of risk and duress. Hard to believe as it may be, given that there's never been more dollars around in the world than there are now after QE, the dollar's going up. Seems completely counterintuitive. You could argue it means that markets are getting a little bit more worried, that risk appetite is ebbing, as we discussed with regard to one of the earlier questions on small caps and emerging markets and junk and so on. So I think it could be an indicator that markets are just not quite as confident in central bank and economic outlook as perhaps they were. And if that's the case, that will probably keep demand for the dollar going very nicely. Thank you very much indeed.